Hello traders, today I'm going to show you a way to use option Stalker to find pre-earnings plays. We're looking 2 weeks out specifically, and we're going to be looking for stocks that have a tendency to rally into their earnings announcement. We're going to use the custom search feature within option Stalker to help us find these trades. You've seen right here that the market has sold off in the last 2 months, so option implied volatilities are relatively high. You can see that the market is finding support on the 200-day moving average. So with higher option premiums, I'm going to be more inclined to look for out of the money bullish put spreads to sell as opposed to buying calls. If the market had a more bullish tone to it right now, then certainly if we find a stock that likes to rally into its earnings announcement and the option implied volatilities on that stock are relatively inexpensive, we will want to be call buyers. In the money calls with a very short expiration cycle that have a high delta. That's what we would be looking for. So let's use the search and see what we come up with. I'm going to click custom search, and there's our custom search box right there. I like to trade options, so we have a way to measure option liquidity. I'm going to put a value of 2 and 10 is the max value, so these will be fairly liquid options. I'm also going to select weekly options because I like to trade weekly options. If I'm selling, I like to sell weeklies because the time decay is accelerated. I'm also going to mark pre-earnings bull right here. So this is a search that goes out and finds stocks that have rallied 75% of the time or more 2 weeks into earnings announcements for the last 2 years. So we have all the statistics. We can find these stocks. Today is April 12th. I'm going to click this box right here because now I can actually search for stocks that are going to be announcing earnings within a specific time frame. So given that I want to sell an out of the money bullish put spread, I want that spread to expire before the company announces earnings. I do not want to hold this position over earnings. So the next major option expiration cycle is April 20th. So that'll be the first date that I want to select because I want to make sure the earnings are after this date. So I'll go April 23rd. So if I sell options that expire on April 20th, I won't have to worry about holding over the announcement because the earliest date is April 23rd. And now I can actually go out a couple of weeks if I'd like to. And why don't I do that? So I could be looking at April 27th this whole week, but let's go out to April 4th, May 4th, and see what we get. So now I'm going to hit the search button. Lots of stocks. Got a lot to look at. Let's narrow this just a little bit. In fact, there are a few ways that we can narrow it. Let's make sure that the stock currently has relative strength versus the SPY, and that narrowed it pretty considerably. We might also want to have a major moving average to lean on. Let's see if there's a stock above the 200-day moving average. Yes, there are actually quite a few that we can take a look at, and some that we all recognize that have very good option liquidity. So this is a good starting point for us. We have maybe 7, probably 10 stocks to look at. I'm going to move this off screen and I'm going to double click each one of these symbols to try and find my spread. First on the list was Apple. Really nice setup. Got the 100-day moving average right here. We have our pressure indicator very, very negative and the stock being able to move higher on a bullish buy signal right here. This is what I call the holy grail right here. And we have the stock in positive, it's strong relative to the SPY, which was one of our search criteria. I'm going to expand this a little bit because this is such an important indicator for me. I like to use it, so I want to make sure that you're able to see it. So we have negative pressure, yet the stock, even with this negative pressure, is able to move higher. Very, very bullish setup. So here I would be looking to lean on that 172 100-day moving average here. So I'd probably sell a 172.50, 170 bullish put spread. And I'm going to click on option pricing. And we're in April 20th. So let's scroll down and get to that 172 strike. And there you can see that they are 142 bid, offered at 81. So we can get a 60-cent credit. Probably if we squeeze this, we might even be able to get a 65-cent credit. So we're difference in the strike price is $2.50. Let's say we can get 65 cents for it. We have to put up $1.85 to make 65. That's about a 33% return in a week. Not too shabby. And we have probability on our side because we know historically Apple has rallied into the number. We also have that 100-day moving average that we're leaning on. We also have our holy grail buy signal with a negative pressure reading. We also have strength relative to the market. That took me less than 5 minutes even explaining it to you to find this trade. Let's look at another one. AFL, that's a stock split. I'm going to skip over that. Amazon, I tend not to trade Amazon simply because the strike prices are a mile wide and oftentimes you can't even tell where you're going to get filled on a spread because you've got dollar bid-ask spreads on the options. So I'm going to bypass Amazon. I sure wish they'd split their stock though. Make a lot of people happy. The next one is Boeing. Boy, does this look good. We've had that negative pressure down in here and we have our buy signal and we've got the 100-day moving average to lean on and we have strong relative to the market. So we've got lots of good things happening here. We also have the stock poking above this little resistance level. Boy, I'd like to see it even above here. But right now, if I'm selling an out of the money bullish put spread, I can use that 320 strike price. And let's see if we can get any premium for it. So we're going to try and use that 320 strike and the 320, 317.50, $1.48, $1.29. You can only get 20 cents for that right now. And it's not a lot of premium. So we'd probably have to go closer to the money. And in this particular instance, it's at 337. The stock is at 337. I wouldn't feel comfortable getting in here, although you certainly could. Right now we have the market moving higher, so I'd probably have to go up to a 330, 327.50 strike. So this wouldn't be my favorite just because I'm a little away from that support level and I like to be a little bit closer to it. But hey, if the stock's going to rally into earnings, we've got that momentum and we've got the other things working for us as well. This certainly could be a good trade. I just have to go a little bit closer to the money and we'll take a look at that right now. We'll go up to the 330, 327.50. You've got a 345 bid offered at, let's call it 295, so you could get 50 cents for that. Not great, and you are $7 out of the money. So with a week left, that's not too bad, I guess. That's probably about a 25% return for a week. That's pretty nice. Let's see if we can find anything else. Caterpillar, we're below that 100-day moving average. Something down in here would be nice, but we have to go too far out of the money to get anything decent for it. FCX, you could use that 100-day moving average right there. That wouldn't be too bad. I'm just very quickly going through now. This is kind of nice. It's just poking above that 100-day moving average. This is LVS and not great relative strength to the market. And this is kind of indecisive on the pressure indicator. So let's keep going. Here I've got a divergence, I've got negative pressure and a trade signal buy. A lot of distance though between here and the strike price. SQ, this is not bad if we can get something for that 45 strike price right in there, but the stock is at $49 right now. So we'll take a quick look, but I don't think we're going to get much down on the 45 strike price. You can see that right now there's not a lot of premium in those, so would not be a great choice personally. So we've got STX, love the relative strength here, very strong relative to the market, trying to break through here. We've got some support right here at about the $55 level, horizontal support right there. We could lean on that, but we're $4 out of the money. We're not going to get much for that. Looking for something that's very close to a major support level. Texas Instruments 104. We've got the $100 strike price in here. It looks like it's getting ready to poke through the 100-day moving average. And something like this stock does tend to rally pretty well. Let's take a look at the option implied volatilities. Maybe this would be a good call purchase above this $105 price level. So we'll be looking at, I'd like to go out now. Since I'm buying options, I definitely want to go out and buy some time. And so I'm going to go out to the May expiration, monthly expiration, and I'll take a look at those premiums. So at the 105 strike, we're looking 325, 335. Excuse me, yes, 325, 335. So let's go high and say 350 if the stock breaks through here. So $3.50, and the stock does have the potential to get to maybe 112 before it announces earnings. So those options would be in the money by 7 points. At very least, that would be a double if it can get up to this 112 level. So that would be a good strategy pre-earnings. We do have to look at the option implied volatilities. I think they're going to be pretty expensive. So I click on the option, and then I can see the orange line tells me where the option implied volatility is. It's under 35, so I'd actually be okay buying options on this one. You can see the stock volatility is the blue line, but the orange line is the option implied volatility. It's actually been coming down, so these options are relatively cheap on a historic basis, and this goes back, about a month or so. So not a bad play there. I would consider that. And wind. Wind's got this nice little uptrend line right here, breaks through horizontal resistance, got a buy signal, relative strength. This might be a pretty decent play, but now that I have to go through all of the different stocks that I've shown you, this probably took me about 20 minutes to conduct and record. I'm left with, this is my best pick, Apple. It's really close to this 100-day moving average. I've got this perfect holy grail setup with the buy signal and the negative pressure, and it's got good relative strength. It's very liquid, so this would be my first choice. And let's also take a look at the option pricing for Apple. We'll go into the May expiration. And we'll take a look at those. And we'll go with the 180 strike. These options are also pretty reasonable here. You can see that option implied volatilities have been dropping, and it's down to 26, which is quite reasonable. So for a tech stock, buying calls on this would also work. And you've got that breakout. This would be your stop point right here. If the stock closes below that 100-day moving average, you would stop out of the trade. So that's how we use the scanner to find these earnings trades. Now I do want to point a couple of other things out. First of all, I could take off some of the restrictions that I had on the stock, and I'll click scan again. And then we can look at all of these different possibilities. There are all sorts of trades that you might find. So instead of marking uh, relative strength, I could have gone in and said, hey, show me the stocks that are on a buy signal. And so I can focus on these stocks. Baidu might be an interesting one to take a look at. Facebook, McDonald's. Let's do a couple of them. Let's see if we can find another one. All I had to do was modify the search, and that quickly it's done. And I love this right here. This is right down on that 200-day moving average. So that would be, we could lean on that 170 strike price. That would put us a little bit in the money. And let's see what those options are going for. We'll use the April expiration and 170.65. You're not going to get much of anything for those. So no trade there. Even with the stock 3 points out of the money, I'm surprised they don't have a little bit of premium in them. I'm looking at the wrong strike. The 175 puts is where we want to be. So 175s are one. You can see these are a mile wide. $1.60, 345. No interest. So AET is just too wide. Baidu is one that I wanted to look at. So I'm clicking on Baidu right now. Got nice horizontal support here, but the stock has moved off of it pretty considerably. And we'll take a look at the calls. If it gets through the 200-day moving average, then it's going to be fighting the 100-day moving average soon after. I don't like the fact that this is capped, so I don't like it. COF. This would be nice right above that 100-day moving average. Then you sell below it and you use that as your stop. So this would be actually a nice candidate. Facebook coming up, a little bit of relative strength here. It's been weak relative to the market, so I would say probably not my first choice given this decline. It's below the 200-day moving average. It's below horizontal support, so that would not be my first choice. So before I make this too much longer, I just want to point out that there are all sorts of filters that you can do. And as earnings season starts to crank up, these lists are going to get longer and longer. So that means that you can be more and more selective with them. There is a pre-earnings bear counterpart, so you can find bearish trades as well. Stocks that have a tendency to decline into earnings. And let's run that scan. And there's your list. So you'd want to check these and see if they're in that, well, they are in that time frame. You want to make sure that they've got some technical weakness, some overhead resistance. Now, once earnings actually happen, I'm going to unclick this earnings projected date box right here. And I'm going to unclick this pre-earnings bear box. So now all I have is option liquidity and weekly options. I'm going to clear out the upper portion. I'll just clear upper. So now what I'm going to do is I'm going to take a look at I'll look at pre-earnings. I'm going to mark this box. What pre-earnings is, these are all the stocks that are going to announce today after the close or tomorrow before the open. So this is my last chance to trade them. And I'll click scan. And you'll see a couple of them. And it's because I've got this option liquidity and weekly options marked, but these are two of them. So we've got Citigroup and JPM are both going to release earnings and have liquid options. I'm going to remove the custom search and show you another feature. This is pre-earnings options. So I'm going to click that, and we can see all of the stocks that are going to be announcing after the close or before the open. We can also see the expected move, and this is on a percentage basis. So they're expecting Citigroup to move 3.77%. Well, the average move that it makes is 2.41%. And the number of times that it's exceeded that in the last 8 quarters is 26% of the time. So about a quarter of the time it will exceed the range, the expected move. So if you're an option buyer, that's not a very good statistic. If you're an option seller, it'd probably tell you that, yeah, I'd probably want to favor the sell side. Now here's one, INFY. You can see the expected move is 5%. The options are priced at 5.36%, and it tends to surprise 60% of the time. So if you were looking to buy options, then you would obviously like INFY. If you continue, you can look at the put call ratios, the group performance. You can take a look at the money option implied volatility. In the case of Infosys, you can see they're real expensive, 59. And then finally, the option liquidity. Now, I don't trade options and hold them over earnings. I know some of you might do that. If you do that, this table would be of use to you. Again, just click the pre-earnings options tab. And I'm going to do an entire video, maybe I'll even do 2 videos on post-earnings plays. I love to trade post-earnings. The news is out, stock is reacting, and the scanner will really, really help us find those opportunities. Thank you.